Our next guest says that the economy and the markets are in reasonable shape, but there are some debt issues on the horizon. Joining us right now is Victor Khosla, the founder and chief investment officer of Strategic Value Partners. SVP is a global opportunistic credit investment firm with about $18 billion in assets under management. And Victor, thank you for being here.
A pleasure.
So tell us what you see. Before we get into the markets more deeply, talk about what you see just when it comes to debt potential offerings or debt opportunities, because this is really where you're an expert in this. You see credit problems, you make money on these things. Are we at a point where you see opportunities?
Absolutely. So what has happened is, look, the economy, as our view, economy is in kind of reasonable shape in the US, so in Europe. It's much more of a slog, right? And in a world which kind of looks like that, all the new investments people are making today, the new vintage funds they're raising, probably more than likely it's going to work out reasonably well. Problem, the 800-pound gorilla in the room is all the investments we have all made before the Fed started to hike rates. Can I give you a sense of that? Just how big?
Yeah, please.
Yeah, and please, this is a corner of the market. It's not the broad markets, right? So private equity funds have $5 trillion invested in the ground, 26,000 companies today. Mm-hmm. There's $5 trillion of high-yield debt in Europe and the United States. There's $8 trillion of mortgage debt in Europe and the United States, right? So you've got, and all this stuff in a world was issued, done, a lot of it in zero-rate environment, right? Now you've got higher rates, you've got maturities coming at you, and please, I'm not here trying to tell you, oh my God, it's going to be some big collapse. We don't really think so. But my God, it's going to be a slog working our way through this pile of stuff which needs to be refinanced and fixed over the next 3 years.
Mark Lasry was here recently, and he said he didn't think prices were at prices that were all that attractive just yet, that you can't get the kind of deals he would be looking for. Do you see deals?
Mark's a very smart guy, right? The only thing I can tell you is us. Over the last, look, we've got $18 billion. Over the last year or so, we've invested about $3.5 billion. What I'm describing, this is not like, oh boy, it's going to happen next year or next year. It's happening right now. Our pipeline of deals we look at, and look, we have a really big team, okay? We've got about 100 investment professionals. Our pipeline of deals is $200+ billion, 100 or so deals in the corporate world, not to mention equivalent numbers in the real estate world, just where we are today.
Yeah, I was going to say, where are the sectors? Where do you see this? Commercial real estate is often mentioned. Where are you seeing opportunities?
On the corporate side, where companies have to meet these debt maturities, right? We're seeing private equity funds wiggle, right? Do a lot of adventurous financings, and some of them are saying, "Hey, all yours." We just bought one of the largest the largest parking garage business in Europe, right, with 2 million parking slots. We're just in the process of taking over a ferry business. They run the Statue of Liberty ferry, the Alcatraz ferry, right? They own a bunch of ferry businesses in the United States, right? So the corporate side, it's starting to happen. On real estate, you are right in the center of the storm. It's the old-fashioned GFC-like an office property. Mm-hmm. It's old-fashioned GFC-like. There's a tsunami coming through. We must have looked at 75 office deals over the course of the last 5 months.
And what's the price that you get on that? Is it 50 cents on the dollar, 60 cents on the dollar, 70 cents?
Buying the mortgage debt, typically, real estate prices in office in the public markets with REITs are down about 40%. In the private markets, transactions are taking place down 60%, 70% from before the Fed started to 60, 70%. from before the Fed started to kind of hike rates.
So is your worst nightmare that the government steps in and makes it easier for the banks to extend these loans, for forgiveness to come to those who have signed these deals?
The government is not so forgiving, right? It's like they are not going to help the real estate entrepreneurs, the ones who kind of bought these companies with very high leverage. Well proven in the United States, right? In the past, they'll help the banks, they'll help people with systemic risk issues, but they're well proven in the United States. They're not going to.
But are the banks in trouble? Are there, let's say, regional banks that have so much on their books that this would cause a problem?
You know, the U.S. banking system, the big ones, the $2 trillion banks, the $3 trillion banks, modest exposures to kind of commercial real estate. Of course, they're going to take write-downs, but with the high equity buffers, they're strong. It's a group of regional banks with 30%, 40% of their loan assets invested in real estate and 8%, 10%, 12% sort of equity cushions. Those are the ones, and look, you've seen them. Every 6 months we wake up and suddenly there are a couple of regionals who are like, oh my gosh, right? And I mean, so they have trouble.
They're absorbed by the system now.
They are.
So next week, we're expecting that the ECB could cut rates. How does that change things for you? If you're looking at the U.S. and Europe, does that offer relief in Europe?
By the way, first time
for the existing ones, not for you.
Absolutely.
Yeah.
Of course, there's relief, right?
But the first time ever that Europe is going to cut before
the U.S.
Yeah.
You know, and they have, Europe, the economy itself is in such a tough place that their inflation has gotten under better control. So they have the ability, because the economy is in such tough shape, right? And as a result, they have the flexibility with inflation down to be able to do some of those things, which we don't quite have yet.
Victor, you are very upbeat. You seem very happy. Is that you all the time, or is that just because you're finding all kinds of grave digger bargains that you can find? Great answer.
It's a really good environment for us. Look, as credit cycles go, right, there hasn't been one big, long opportunity in credit since 2008. COVID was 3 months long. You blinked, it was gone.
Because the government stepped in.
Yeah. Oil and gas crash, 6 months. There hasn't been this sustained workout, right? And please, it's not like some huge drop in prices system-wide. Don't think so. But just that sustained set of opportunities for us to work through, we feel pretty good about our pipeline.